So good morning, everyone, and thank you for joining me and the Henderson Logie team for this webinar on family investment companies and trusts. Today, I am joined by my colleagues from our private client team, Lucy Crowe and Ed Marriage, and they will take you through this very interesting and topical presentation. At the end, I will host a question and answer session, so please do put any questions in the chat box as we go through the presentations, and we can cover those at the end. So to set the scene for this webinar and to explain the relevance of family investment companies and trusts, most of you will be aware of the sweeping changes to the inheritance tax regime announced by Rachel Reeves in last year's autumn budget. We are facing the freezing of the inheritance tax thresholds, caps on the valuable reliefs that we have for farms and businesses, unutilised pension pots coming into the charge to inheritance tax for the very first time. And this will undoubtedly mean that more estates will fall into the inheritance tax net. And in many cases, unexpected liabilities will be triggered. Most of you will also have heard yesterday's announcement that this year's budget will take place on the 26th of November, and rumours are rife that there are going to be further tax rises to fill an expected budget shortfall. In terms of the agenda for today, Lucy and Ed are going to cover trusts and family investment companies, and they will also take you through some planning strategies using these structures, which can be tailored to suit your personal circumstances and also used to reduce your tax liabilities. So I'm now going to hand you over to Ed, and please do remember to pop your questions into the chat box.
Good morning, everyone. Thanks, Dawn. So as mentioned, I will be discussing trusts, what they are, how they work, and how they can be used as part of an overall strategy when doing estate planning. So if you did see our webinar last month, you will be aware of the significant changes that Rachel Reeves made to the IHT regime, which Dawn just highlighted. And it's largely due to these changes that trusts seem to be making somewhat of a comeback for estate planning. So if we start at the beginning, what is a trust? So a trust is a legal arrangement where one or more trustees hold and manage assets on behalf of beneficiaries. So the settlor creates the trust and puts the assets in. The trustees are the legal owners who are responsible for managing those assets. And the beneficiaries are the people who benefit either through income or capital. Trusts are incredibly flexible. They can be used to protect assets for children or grandchildren. They can be used to ensure that wealth passes down in stages rather than all at once. Protect vulnerable beneficiaries who can't manage money themselves. And importantly, they can reduce exposure to inheritance tax if they're used correctly. So firstly, we'll start with what types of trusts are there. So there are many types of trusts, and they're designed to fulfill specific needs and uses, and these are vast in number. So in the interest of not taking all morning, the three main types of trust that we see day to day when planning are bare trusts, IIP trusts, or sorry, interest in possession trusts, which is life rent in Scotland, and discretionary trusts. So in bare trusts, assets are held for a named beneficiary who has an absolute right to the assets. They are simple, but they offer the settlor little control. Predominantly, they're used for minor children as a means of moving assets out of the settlor's estate and having the trustees hold them for the beneficiary before they're of age to own them. The big downside of bare trusts is that as soon as the beneficiaries are of age, they can demand the assets outright and take full control. With IIP trusts, a beneficiary has the right to the income from the trust during their lifetime, but the capital can pass elsewhere later on. So this is quite commonly used in people's wills when someone wants to provide for the surviving spouse, but ensure that the capital ultimately passes down to the children. You see this quite a lot where someone has remarried and has children from the first marriage. They want to provide for their spouse, but ultimately they do want the assets to go down to their children. And finally, discretionary trusts. This is probably the most common type that we see in our day-to-day planning. So with discretionary trusts, trustees decide which beneficiaries benefit, how much, and when. It's the most flexible type, and it's widely used in estate planning due to the control that it gives. Essentially, it can allow the settlor to remove assets from their estate, but not have to worry about what the beneficiaries will do with it. And the flexibility of the structure will allow the trustees to make provisions for the needs of each individual beneficiary on an individual basis. So now if we look at how trusts are taxed, so when we move assets into a trust, there are three main taxes that come into play. These are inheritance tax, capital gains tax, and income tax. So for inheritance tax, when the assets are moved into the trust, these are called chargeable lifetime transfers. If the amount transferred is within the nil rate band, which is currently $325,000 per person or $650 for a married couple, there is no immediate inheritance tax. However, if the transfer exceeds the nil rate band, then there is an immediate 20% charge on the excess. So if we take an example of putting $500,000 into a discretionary trust, 325 would be covered by the nil rate band, but the remaining 175 will be taxed at 20%. So there's a £35,000 tax charge immediately. The exception to this is that if the assets are covered by other allowances, such as business property relief, this gives you the ability to transfer much more than the 325 without incurring a charge. Trusts are also subject to periodic charges, which is more commonly referred to as the 10-year charge, where every 10 years the value of the trust is tested against the nil rate band at the time, and any excess can face a tax charge of up to 6%. In practice, it is often less than 6% because of how the calculation works. But if you are considering trusts, it's a cost to bear in mind. Similarly, when the trust is closed, it will be subject to an exit charge, or when assets leave the trust, for example, if you're giving them to a beneficiary. And this rate depends on how long the trust has been running since the last 10-year charge. And it's calculated on a prorated basis, so it will be less than 6%. We also need to consider capital gains tax when moving assets into a trust, as the transfer is treated as a disposal for CGT purposes, and that will be a market value. So this can crystallize a gain even if no money changes hands. However, where a disposal is immediately chargeable to inheritance tax, and that is even if the transfer is within the nil rate band, holdover relief is available, which essentially means that the trust will inherit the settlor's base cost. And finally, trusts are subject to income tax. They are not tax-free wrappers. So income generated inside a trust is taxable. For discretionary trusts, income is taxed at the trust rate, which is 45% for non-dividend income and 39.35% for dividends. However, with trusts, when beneficiaries receive distributions, they can claim a credit for tax already paid by the trustees. So in theory, it is possible to avoid any income tax. So now that we've seen how trusts are taxed, let's focus on why they're still such a valuable tool in estate planning. So despite the charges, they provide some unique advantages that can't be replicated easily elsewhere. And the first big benefit that I've already touched on is holdover relief. Now, if you gifted an asset outright to your children or your grandchildren, this would be treated as a market value disposal as your connected persons. Therefore, you'd have to pay capital gains tax on a gift where you've received no money in return. So just as an example, if a couple gifted a £600,000 property to their children, which they purchased for 300k, HMRC would see this as them making a capital gain of 300 grand and would require them to pay £72,000 in tax, even though no money has changed hands. On the other hand, if the couple had placed the property into trust, holdover relief can be claimed and the trust would inherit their base cost of £300,000 and there would be no immediate capital gains tax charge, and they would have removed the property from their estate. The second and possibly most important use of a trust is the control that it gives the trustees over the assets. So if we use the same example again of the £600,000 property, if this was gifted to the children by the parents outright, as soon as it's gone, and the parents have no control over what they do with it. They may have wanted the kids to keep the property as future retirement planning or to rent the property out and use the income to pay for their education. However, if the kids decided to, they could sell the property and use the funds to go traveling or on, one hell of a night out. But the trust allows the parents to have the peace of mind of knowing that the property can be used for the purposes that they intended. A third benefit, perhaps somewhat forgotten, is the protection that a trust can provide. So if it's structured correctly, a trust can be used to shield assets from beneficiaries' spouses in the event of a matrimonial breakdown. So if we use the same example of the house, if the parents had transferred the property outright to their child and they had subsequently separated from their husband or wife, the property would form part of the marital estate and some or all of it could be taken by the spouse in divorce. So very much not what would be intended by the parents. If, however, it was placed into a trust, this would not be an issue, and it can give the parents assurances and some peace of mind. Now, one of the big changes announced by Rachel Reeves in the October budget was the restriction of APR and BPR. So this is agricultural property relief and business property relief. This was covered in our previous webinar, but just as a quick recap, APR and BPR are IHT reliefs that give the individual 100% relief on business assets and agricultural assets of unlimited value. Following Rachel Reeves' budget, there was a cap of £1 million per person for both APR and BPR cumulatively, and that takes effect from April 2026. Any value now above that 1 million will only receive relief at 50%. As part of this announcement, trusts will also be able to receive their own £1 million allowance. And this essentially means that a married couple could effectively increase their 100% BPR APR relief from 2 million for the couple to 4 million by utilizing trusts. So, I mean, also as part of these changes, there is a small window now before April 2026 where a unlimited amount of APR BPR assets can be passed into trust without incurring any CLT charge on entry. So effectively, this means if you have a trading business worth 10 million, you could put this into trust, suffer no immediate IHT or CGT, and as long as you survive 7 years, there will be no immediate tax payable. This can be hugely beneficial for business owners who are wanting to pass down their business to the next generation, but they don't fully trust them yet to control the company in their best interests. So it allows them to retain a level of control. And finally, another use for a trust that we see quite a lot is school fee planning. So this is essentially using a trust to redirect income from the parents or grandparents who are higher or additional rate taxpayers to the children or grandchildren who either don't have a job, are in their education, so they don't have an income, and they have unused personal allowances or are taxed at a lower rate. The income can be paid to the beneficiaries tax-free, as the tax paid by the trust on the income is reclaimed through the beneficiary's tax return. So if we take an example of, say, 15 years of school and university for a child, this can allow you to extract around £200,000 tax-free to use for the child's education or living costs. And this would save tax of about £80,000 if it had been taxed on the parents instead. So So as we can see, trust can be incredibly useful in estate planning and income tax planning, and if used correctly, can help parents and grandparents achieve savings while allowing them some control over the assets that they're passing on. And with that in mind, I'll pass over to Lucy, who's going to be discussing family investment companies.
Thank you very much, Ed. As Ed mentioned, we've seen a real rise in the number of trusts that are being set up, or existing trusts that are now being more utilised. But bigger than the increase we're seeing in the use of trusts is the use of family investment companies. Family investment companies have been around for a long time, but there has been a massive increase in the last few years in the way in which they're used in inheritance tax planning and just in the number that we're seeing set up. So we'll start with what is a family investment company. So it is just a normal company. It's a straightforward company. It's usually set up as a private company limited by shares, but the way in which we set it up makes it a useful tool in inheritance tax planning. One of the key features with a family investment company is that both the directors and the shareholders are usually individual family members. I will say here, while we're going to focus on family investment companies and compare them very much to trusts, a lot of the family investment companies we set up, we will also put in a trust as a shareholder, because that can be a really useful tool there as well. So if we now have a look at how do you set up a FIC? How do you make a FIC and not just a standard company? The first thing is all companies have articles of association. With a FIC, you want to make these very bespoke. And this is one of the most important things when you're setting up a FIC. The kind of things you can put into the articles of association are endless, but it's really the running, how the company is going to be run. What are the rules around how the company will be run? Ed talked a lot about protection and control. That would all be built in through the way the articles of association are set up. It can be set up such that shares cannot be passed out of the direct family line. Doesn't have to be, they can be available to anyone, but if you want to make sure it's only going down that family line, perhaps protecting from children's future spouses in the event of divorce, or them selling it to the random person they met on the street, that's the kind of things that you can get put into the articles of association. One of the key features that makes a FIC a FIC is, excuse me for 1 second, is the different classes of shares. So known as alphabet shares, and I'll go into that in a lot more detail on the next slide. Having different classes of shares is a key feature. The next thing is not a necessity. You have to have articles of association, you have to have shares. You don't have to have a shareholders agreement, but you're going into business with family, and hopefully family never fall out, but we've probably all seen it. It happens. A shareholders agreement is something we strongly recommend to anyone setting up a FIC. It just sets out what would happen in the case of a dispute. And generally speaking, we see that where these are set up, it actually prevents a lot of disputes. So highly recommend a shareholders agreement. And the last thing is to appoint the directors. Now, as we said on the last slide, likely to be the individual family members. What we often find is that actually when a FIC is started, it's that chopped generation who have the wealth, who are creating the FIC, who would be the initial directors. It doesn't have to be. You can appoint a completely impartial director to run your company. You could appoint your children in the first instance and say, right, we're having nothing more to do with this, it's on to the children. Generally speaking, we would see that top generation who are setting it up being the directors, and then bringing their children in and the future generations as and when they feel that they're ready. So we'll now look at the shares. I think a lot of people have probably heard of alphabet shares. What we find an awful lot when we start to speak to clients or potential clients is that there's actually a lot of misconceptions around alphabet shares. Alphabet shares are a fairly standard part of planning when you're creating a company, especially a FIC, but there's lots of different ways in which they can be set up. So I suppose, first of all, what's the reason to create alphabet shares? The most common one we see is it can give you that flexibility in distributing income. Another big advantage is that it can help you separate the control from the economic value. So how do we do this? Well, ultimately, your shares, you can decide with each class of shares whether they have the same rights to income, capital, and be voting or non-voting. So your most standard alphabet shares would be where there's different rights to income, but all the same rights to capital and voting. These are the least likely to be challenged in any way or looked at by HMRC. And it means that when you're coming to pay out dividends, you can pay dividends to one class of shares and not to the others, or you can pay different amounts to the different share classes, or it might be that you pay at different points in the year. So massive flexibility. It means that the top generation can continue to access income, even though they've perhaps given away some of the capital with their children owning some of the shares. It means that children can get only what income the directors think is appropriate. So the income might be, and it can also be paid at the right time. So if you've brought children in as shareholders, Ed mentioned school fees planning. If you bring them in, perhaps while they're at university, you might pay it in time to pay university tuition costs or accommodation. So lots of flexibility in there. You can, of course, also change the rights to capital on winding up. Shares that have no right to capital generally are worth a lot less than those that have a right to capital. So that can be a way of getting the value down the generations. And then the last decision is whether they'll be voting or non-voting. So generally speaking, your top generation, the one who are going to have control, will have voting rights. It may be that you have voting rights with all of the shares, because if the children have fewer shares, then even though they get a vote, it's going to be out. The parents can still outvote them. So you can keep the control just by the number of shares everyone has, but you can obviously also look at the shares and structure them to have some that are non-voting. And the last point on the shares is that you can have as many different classes as you like. So you can set up a class of shares for perhaps the parents, a different class for the children, so they've all got the same. So you've got A and B shares, or you could have both parents with different classes of shares. So A shares for one parent, B shares for the other, and then C, D, E shares for each of the different children, depending on how many other family members are coming in. So unlimited number, depending on what's going to suit. Obviously, we are tax specialists, so there was always going to be a slide on the tax. The tax on the setup of a FIC is not as straightforward and prescribed as it is for a trust. It's the same taxes that we're going to look at, inheritance tax and capital gains tax being the two biggest ones. I will say I've also put it on there, LBTT, Land and Buildings Transaction Tax in Scotland, or stamp duty in the rest of the UK, where you're putting property, which is something we commonly see put into a FIC, especially residential properties. You do need to look at the LBTT or stamp duty as well. But if we start with inheritance tax, because that's a tax we're trying to save, and is often the big driver for setting up a FIC. In comparison to a trust where we had that chargeable lifetime transfer, you can structure the setup of a FIC so that it's not a chargeable lifetime transfer. So for the purposes of ignoring the other two taxes for now, let's use an example of £1 million in cash. If you want to put £1 million in cash into a FIC, the first option would be to put the £1 million into your FIC, and in return you receive £1 million worth of shares. Well, at that point, you have not changed what your estate is worth. You had £1 million in cash, you've now got £1 million in shares. Your estate hasn't changed in value for IHT, so there's no IHT transfer, there's no lifetime IHT charge. The other option might be that you've already got shares, you've already set up the FIC, and you and your family members all have shares, and then you put in your £1 million cash, but in return, you've now created a £1 million director's loan account in credit to you. That means you can draw down up to £1 million out of the company without paying any income tax on it. But while that £1 million is owed to you, that's an asset that sits in your estate. So £1 million cash has gone out, but £1 million director's loan has come in. The third option is that you give the cash. You don't receive any kind of director's loan account. You don't receive any kind of shares. At that point, that would be a chargeable transfer. Just like a trust, that's a chargeable lifetime transfer going into your FIC. Now, if you've got your available nil rate bands, as long as you've not already set up a trust within the last 7 years, you'd have that nil rate band of 325,000. And above that, you would pay that lifetime IHT rate of 20%. So 3 very different options for setting up the FIC, and that's just an example using cash. I will say for some of the FICs we've set up recently, it's been a combination of those options as well, just to utilise the different bands. If you've got assets that qualify for agricultural property relief or business property relief, you can put those into a FIC. You could gift it outright, and rather than being it would still be a chargeable lifetime transfer, but that agricultural or business property relief would give you relief, so there would be no tax due. Just as Ed mentioned for trusts, it's exactly the same. That £1 million cap is coming in from April 2026. So you can put in any value of agricultural business assets up to April 2026. Although if you die within the 7 years, then it would be taxable above that £1 million limit, but that would be the same as if you'd done nothing. So something worth thinking about there for people who have agricultural or business assets that they might consider putting into a FIC. If we now move on to capital gains tax, just like a trust, any transfer of an asset other than cash, because cash isn't subject to capital gains tax, any other asset into a FIC is a deemed disposal at market value. So just like a trust, when you're putting it in, you do have to consider what that gain is. The difference to a trust is that where a trust you can hold over on almost any asset, you can't with a FIC. So you can only hold over if it's a qualifying business asset. So if you're looking to put residential property into a FIC, to use the example that Ed used with a trust, if you've got a £600,000 property, of which the gain on that is 300,000, when you put it into the FIC, that £300,000 would be taxable at the time you put it in. If it's residential property, taxable within 60 days as well. So careful with the capital gains tax when putting assets into a FIC, and obviously where it is property as well, LBTT or stamp duty. There are pretty much any asset can be put into a FIC. The thing we would strongly recommend is just sitting down, getting good advice, and getting the right combination for you, your family, the circumstances. I don't think, and you can ask my colleagues Dawn and Ed at the end in the Q&A, I don't think we've ever set up 2 FICs that are the same. And we've all been doing it for quite a number of years now. So every single one is different, and it's just about getting the perfect structure for you and your family. So once we've got our FIC set up, we've dealt with all the tax on getting it set up, we now need to look at how we run the FIC and what the tax is going to look like on the day-to-day basis. And hopefully the next slide, there we go. So you've got your FIC, you've got your shareholders, you've got your directors, hopefully, and you've put all your assets in, it's generating income. What happens now? So the first thing is that the income generated in the company, just like any other company, will be subject to corporation tax. And I will say, just like any other company, we'll need accounts prepared and corporation tax submitted as well. So your corporation tax, taxable on pretty much any of the income other than dividends. So if you've got a lot of assets producing dividends, that can be quite an efficient thing within a FIC. And then it may be that you are running the FIC just purely to accumulate wealth within the family. That's fine, you've paid your corporation tax and that's it. But assuming that family members do want to take an income out of the FIC, you've then got quite a number of different options. So the most straightforward one first, for the shareholders, they can get money out by way of dividends, and we've talked about that with the Alphabet shares. Hopefully each family member has been set up correctly with the right class of shares, and that will allow you to pay the dividends to each shareholder at a level that's going to be both tax efficient and appropriate. But you do have a few more options where you've got directors and perhaps employees as well. You can pay a salary that will have income tax and national insurance consequences, possibly bonuses on salary. And you can also make pension contributions. Pension contributions can be in a very efficient way of extracting funds out of the company. Obviously, for younger members of the family, perhaps a little bit less attractive because they can't spend it. But if that's one of your main driving forces, is to build up wealth and help provide for their future and prevent them from spending money now, that might be a very attractive option to make pension contributions. And then the last one, really only if you're looking to wind the company up. If you get the wind up all done in the right structure, and that's a whole separate webinar on its own, you can hopefully get that subject to the capital gains tax rates. So again, a lot of different options when you've got a FIC for exactly how you get income out to each of the different family members. And likely that every family member has got a slightly different combination of those to get the right structure. So finally, I've talked a little bit about how family investment companies compare to trusts, but let's look now at just a direct comparison. So starting off with the inheritance tax, where we've got the trust, chargeable lifetime transfer. You've got £325,000 nil rate band, as long as you've not already used it in the last 7 years. And anything above that is taxable at 20%, where you've got spouses, they've got 325,000 each, so potentially 650,000. Whereas with a family investment company, you've got quite a few other options. So if you've got agricultural business properties, you can put into either structure, a trust or a family investment company before April next year up to any value. But if you've got assets that don't qualify for any of those reliefs, with a trust, you're going to get that immediate IHT charge above that 325 or 650,000 pounds nil rate band. Whereas for a family investment company, you can structure it, as we said, you're getting consideration in the form of shares or a director's loan account. That means that it's not immediately chargeable to inheritance tax. And that's quite a big advantage there. I think the other advantage we see for family investment companies when you're looking at the inheritance tax is that there's no 10-year or exit charges. whereas there are within a trust. Although I will say that for the 10-year charges within a trust, as Ed mentioned, they're up to a maximum of 6% and usually quite well below that 6% versus the 40% if it had been left outside the trust is quite a significant saving. And for both, we've got whatever's been put into either structure is now growing out with your estate, out with the donor's estate. So that's a big positive. Anything else you would add in there, Ed, on the inheritance tax?
Yeah, I mean, I think just as sort of generally, but not necessarily always. I mean, trusts are a good way of moving assets out of your estate immediately, whereas sort of family investment companies are usually it's usually over time that the assets grow outside your estate. So depending on what your overall goals are, and as I say, you can use a combination of both, but depending on what your goals are, one or the other might be more beneficial if you're looking to do a lot at once, or it's longer term planning.
And if we then look at capital gains tax, for both, it's an immediately chargeable transfer for capital gains tax, and it's a deemed disposal at market value. The big advantage we've got for a trust is that you can hold over on almost any asset as long as it's going to be relevant property, whereas for a family investment company, it's only going to be those qualifying business assets that we can hold over. On income tax, and excuse me, I've had quite bad hay fever the last couple of days, so I will let Ed say something on the income tax just for a moment.
Sure. Yeah. Well, both can be useful. I mean, I touched on the school fee planning for trusts, but the exact same thing can be done for family investment companies if it's been set up correctly. And essentially, what you're doing is you're using dividends or salary or whatever it is to direct income to the children or grandchildren who either pay tax at a lower rate or don't have any income at all, and they have unused allowances. So it's a bit trickier with a family investment company, but it can certainly be done through both means. So it's not just a useful tool for inheritance tax planning; it can also be used for that.
And I think the key probably with both is that as long as you've set everything up right, the trustees for the trust, the directors for the family investment company can control as and when people get any income from a trust or a FIC. And that probably brings us on to our last big comparison there is control. So if you've got the structure right, and that'll be the trust deed for the trust, or the articles of association and shareholders agreement for the family investment company, and structured the shares right, you should have the right level of control and protection in either structure. So really either one would give you that. It's just going to be down to how you set it up. So on to the last slide. And for those of you who joined us last month, you'll see that actually I've used the same slide, and that was not because I was being lazy and didn't want to create another slide. It's because the message here is exactly the same. It's the same message, and it's the most important message to leave you with. It is make sure that you decide what's the right planning for you and for your family. So take good advice, whether that's from Dawn and Ed and myself or your own tax advisor. But it's really important that you get that planning right. And then we like to involve the solicitors, because if we don't get it all set up right, get the legal bits correct, whether that is the trust deed, the articles, any associated paperwork, it's not going to do the job you intended it for. So decide, discuss with a solicitor, then we go off and execute, make sure everything gets done. And I will say here, if you're using anything over £1 million of agricultural business property relief, you're wanting to get that done before April next year, before the 5th of April. If you have any concerns that things might change in the upcoming budget in November this year, you might want to look at getting some estate planning done and executed before that 26th of November deadline. And then once your planning is done, or that stage of it is done, make sure your wills are updated to reflect that. So again, back to the solicitor, and then consider any insurance. So some of the things, the planning you might have done, especially if you've done large transfers, utilising agricultural business property relief. If you were to die, having done that planning, so you've done the planning pre-April, but you were to die somewhere after April next year, but before the 7 years have elapsed, there is a potential IHT charge. You can insure that charge. So again, that's something to look at. So I think our final point before we go into hand back over to Dawn for the question and answer is make sure that any planning that needs to be done is completed before the 5th of April. So if you've got questions, chuck them into the Q&A box, and I'll hand over to Dawn.
Yeah, thank you very much, Lucy and Ed. That was really interesting. I just wonder if anybody's got any questions, if you can just pop them into the box. In the meantime, Lucy, I was just wanting to ask you a question. You sort of said that you can really put any type of assets into a FIC, so you can put property, shares, cash in. Is there a sort of minimum value that you need to transfer in to make it worthwhile in your experience?
That's a very good question, and one we get asked quite a lot. One of the things we probably should have mentioned there, actually, in the comparison of a trust and a FIC, and I did touch on it a little bit. A FIC needs to do accounts just like any other company, corporation tax. So there's an expense there. You've got an annual expense for the annual accounts, annual tax return. A trust does as well, but because of the structure, it doesn't need to have accounts that are submitted to Companies House. You just need accounts to support the tax return, or paperwork to support the tax return. A trust would be a lot cheaper to run on an annual basis. So we see trusts set up very often within that 325 nil rate band. I would say a FIC set up for less than £1 million we've seen, but generally, because the driving force of the protection control is making someone want to set that up anyway, I think for real tax savings, you're probably looking at about £1 million and up. I think our average FICs are somewhere between the sort of 3 to 10 million.
Great.
It doesn't mean it can't be done. Definitely can be done.
Yeah, but about £1 million to make it worthwhile. I see, Steve, Bruce, you've put your hand up. I don't know if you're able just to pop your question into just the little box that says Q&A. That would be great. Thank you very much. Just I'll let you do that, Lucy. Just sorry, another question for you. Do you see people wanting to set up FICs with different rights to shares? So, for example, possibly to give children maybe shares that don't have any voting rights. Is that something that you see families asking you to do?
Yes, I think one of the driving forces that we see with FICs is it's wanting to get wealth down the generations without giving younger generations too much control or access too early, and maintaining control for the older generation who very often spent a lifetime creating it. So yes, utilising non-voting shares can be a way of doing that, but as we touched on, it will very much depend on the family. Sometimes the older generation might just simply hold enough shares that they can always outvote the children. So all shares might have voting rights, but because you've got more, you can outvote them. And as they get older, you can pass down more shares, and at some point that control level will pass over. But yes, in other cases where you're perhaps wanting to get more capital value down to them earlier, but without too much control, non-voting shares can be a really useful tool in that, as long as they're structured correctly.
And I suppose a key point is to get a solicitor involved in helping you structure them.
Yes.
Yeah, so just any questions?
So I think we've got a few now.
All right, sorry, I can't actually.
So one of the questions is, what's the tax position for setting up a loan trust? Mm-hmm. A loan trust is generally a specific product, so I would refer that on to our lovely colleagues at the financial planning team. It's really just a type of structure within a trust rather than a straightforward trust as we're talking about here. So that's perhaps a question just to take offline.
Sorry, I can't. And one in from George, who has said, just generally in a situation where succession planning is being considered between the first and second generation, who would you expect to have sat round the table in relation to director, shareholders, family members? Do you want to take that one, Ed?
Yeah, sure. I mean, I suppose it would depend on the family dynamic. If it's a situation where the first generation is very much in control and deals with everything, then I would probably encourage them to invite the second generation around the table, because ultimately it will be them who will be taking the business on. But then again, with all these things, it is completely dependent on the situation and the dynamics between the family members. But certainly from our experience, when you're doing succession planning, I think it does help to have transparency with the people who will be taking on the business or the assets or whatever it is. And it generally leads to a smoother transition if everyone is aware of the circumstances. But then again, it's on a case by case basis, and there's no definitive answer, I'm afraid.
I think I would echo that and just add to that very often the first meeting does just involve that first generation. But as Ed's mentioned there, for the plan to be fully effective and to really prevent disputes and problems at the point where the first generation are passing away, it's really important to get the second generation involved in the planning. But perhaps the first meeting with just the first generation, just to allow them to find out what the options are, get their head around it before you bring the second generation in, is something we see quite successfully. That.
Yeah. And I think key is just take specialist advice. Have your accountant there, have your tax advisor, your lawyer. It may be necessary to get a valuation specialist as well. So another one, can you retrospectively create a FIC by converting an existing non-FIC limited liability company? And is it straightforward, or are you best to start from scratch?
It's probably a relatively straightforward one to answer, and that is absolutely you can take an existing company and convert it into a FIC. You don't have to start from scratch, especially if the company's already there. It's just a case of getting the right advice, pretty much the same as if you are starting from scratch. Work out exactly what you want that structure to be, get the solicitors involved, because they will need to update the articles of association, reorganize all of the shares, but it's something we see on a fairly regular basis.
And when control is not an issue, what what would be the best type of trust to set up to reduce IHT on a main home? And similarly, if transferring business shares where control is not an issue, what kind of trust would be recommended? Do you want to take that one, Lucy?
Well, we can deal with the business shares first. If you put it into an interest in possession or a life rent trust, there's an immediate right to all of the income. And it's therefore sitting in, and it's usually sitting in someone's estate for inheritance tax. So generally, we'd still probably be looking at a discretionary trust, but it will very much depend on the family circumstances. As far as the main home, that is something I would take very careful advice on. Putting your main home into a trust is something to think very carefully about. Because someone else potentially then has control over whether you can sell it. There's a lot of issues if you're still then living in the main home. That's something just to be very, very careful around if you're thinking about that, and take some advice out with this, I would say.
And when control is not really an issue, is there an advantage of a FIC over a trust? Or I think it just really depends on the circumstances, the family circumstances, doesn't it? I think that's we would need to understand your circumstances before we could answer that one.
Absolutely. I mean, if control really wasn't an issue whatsoever, there is always the option to gift assets outright as well. And then you wouldn't have any control. But that's probably the simplest way to do it. But certainly having a FIC or a trust in the mix does give you some assurance. So if control wasn't an issue whatsoever, then that would probably be the route to look down.
And would an insurance policy cover the inheritance tax liabilities? And also, can you invest in AIM shares with business property relief also to reduce the inheritance tax liability? Ed, do you want to take that one?
Sure. So if you have insurance policies, they can be very dependent on your age and your circumstances and what the IHT liability is. They can obviously be very expensive, and but also very useful if you're prepared to say, I'm going to have this inheritance tax liability and I'll insure against it. Then that is good planning, and you might not need to do more. With AIM shares, so the rules change so that now these only receive 50% relief for BPR. So they don't get any of the 100% relief and the £1 million allowance. So they still can be used to reduce your IHT liability, but they've become somewhat less attractive because with AIM shares, obviously, that it's a very volatile market, and you never know what they're going to be worth in 2 years, which is the required period to hold them to get that IHT relief. And now that the IHT relief has halved, it's just become somewhat less attractive to reduce that liability, but still can be a useful tool.
And just another question for me. You mentioned, Lucy, the 6th of April date, and we know that we've got a budget coming up at the end of November. So if I did, immediately want to get assets out of my estate, what are the steps that I should take?
It really depends on what structure you're looking at. I think if you're looking at a family investment company or a trust, as we said on that last slide, decide on what the right structure is. Then let's get the solicitors involved, get the structure set up, whether it's a FIC or a trust, and then get the assets transferred in. So those are the steps that you would want to complete prior to the 5th of April, or if you are very concerned about the November budget, then prior to then. If you're gifting assets outright, which as Ed said is the most straightforward way of planning, is just to gift the assets on. As we mentioned in the last month's webinar, there are tax consequences to that as well. Yeah. So take advice, but again, get assets passed on before those dates.
Yeah. So the key really is to take advice. So
take advice. Get your tax advice first, then get your solicitor involved, and then execute. And if you're looking at the investment side, so insurance or AIM shares or anything like that, then bring the financial advisors in as well. So sometimes just get all three round the table and get all the planning done.
Yeah, great. So I don't see any other questions coming in. So I am just going to close there. So thank you to our excellent speakers, who I think have given us all some food for thought. You will be sent a copy of the slides, and please do drop any of us an email if you do have any further questions. So thanks very much for joining us, and have a lovely rest of the day. Thank you.
Bye-bye.
Thanks. Bye-bye.
Bye.